Just to come back to this, Daniel, what do you think the overarching message was from the Fed, and did the market interpret that message correctly?
I think that the market did not interpret it quite accurately. Let's start from what they actually said. What they said is, A, that there is room for the Fed to raise rates, as they have been warning about in the last 12 months, and that consensus has to move to 3 hikes, which I think is normal, because the Fed is about 250 basic points behind the curve. So that is perfectly fine. I think that what was interesting was what they said about inflation, because the entire market is geared towards inflation is creeping up, inflation is rising much faster than we expected, etc. But the reality, what we saw in the January inflation figures and what we are seeing in actual expectations, is that inflation has been led fundamentally only by a very weak dollar. And what you see in core inflation and what they have been saying is that the disinflationary pressures are much stronger. Technology, obviously very high debt, and the change of patterns in consumption. So basically what I think is that the market needs to adjust its inflation expectations and obviously come to the levels of rate hikes that basically the Fed has been talking about for more than a year. I think that it's no surprise there.
Daniel, the dollar's not that weak. I hate to... Can we have the dollar index over a longest time period we can put up, actually? 5, 10... There's the euro dollar, but let's get the dollar index up. The dollar index is significantly higher than any period it was before 2015, pretty much, before the middle, significantly higher. There you go, that's exactly the chart I want to show you. So if you look on the, I mean, and actually it looks very, well done team. It's basically within a very small margin away from where it was at its peak, really, if you look at it on a historic basis. From 2012 onwards, it is significantly higher. In fact, it's probably at its average level of the last 6 years.
Yes, but what we're talking about when we talk about a weaker dollar is relatively, particularly to its basket of currencies with which it trades, and has been a fundamental driver of the trade deficit of the United States, in fact. So one of the, yes, as you can see in that chart as well, it has been trending lower for 2 consecutive years. And I think that if you look at the strength of the U.S. economy, particularly relative to other economies, and if you look at basically the trends in both the trade surplus of other countries and the differences in the utilization of currencies, the U.S. dollar utilization has gone up, while the euro currency has been going down, according to the BIS, to the Bank of International Settlements. So therefore, there's an anomaly there, and it's based on the view that interest rate hikes and inflation are going in an opposite direction to what the Fed is talking about.
I'm sorry to belabor the point, but I will belabor it, just yes, if I may. Look at the euro dollar, I look at the dollar yen. I look at all of these charts over a 5 to 10 year period, and actually the dollar's at a very mean level. I would suggest it's probably very near its mean level over those periods. Dollar yen, we've seen 124, we've seen 81, and now it's trading 108.
But is that consistent with an economy that is growing faster than what we expected? That in terms of inflation, it is showing a much stronger inflation that was initially expected in 2012, 2013? I'm not entirely sure. I think that the dollar is undervalued here.